Greetings. Barry Sternlick, the CEO and chairman of Starwood Capital, said commercial real estate is facing a Category 5 hurricane. And I know that he's right. He's one of my mentors and certainly one of the greatest real estate investors this country has ever seen, second to very few. I would say that you might want to consider there's also a tsunami of defaulted and distressed debt coming our way. Over the course of the next 2 years, there's more than $2 trillion worth of loans that are more likely to default than not. Um, I sort of look at us in a emergency preparedness situation. The sirens are starting to sound and they're getting louder and louder. Literally every moment of every day, there's more bad news. And instead of historic tailwinds, which we've had over the course of the last arguably 30 or 40 years in commercial real estate, these are starting to turn into headwinds. So without further ado, let me share my screen and we'll jump right into it. By the way, we call these pop-up webinars because they're informal. Informal, but hopefully they're valuable. We're not going to go back and change the lighting, change the equipment. We don't edit. This stuff goes directly from this conversation to both our website and to YouTube and a variety of other channels. Ooh, wrong screen share. Sorry, guys. See, that's a great example. Let's try it again. Pretty sure that's the right button I clicked the first time, but whatever. Maybe I need a new computer. Yeah, so I'm the CEO and Chief Restructure Officer of Performance Advisory Group. This is our philosophy. This is my philosophy. I mean, how do you take one of the most brilliant men associated with a phrase and say that's not extraordinary? What we do over the next couple of years very well may define the rest of our lives because commercial real estate is so distressed. It's so dislocated. And there is so many challenges associated with it that we either will attempt to survive or we will thrive. There's really no in between. Albert Einstein says, in the midst of every crisis lies great opportunity. And my friends, I think the opportunity is here today. I've been in this business only for like 32 years, starting as a very young VP with Bank of America, running eventually some of their larger distressed portfolios and creating their special servicing group where I was the CEO, attending to commercial mortgage backed securitized assets loans, really. But since then, I have not seen the kind of opportunity that we're seeing today. So my question is, prepare for the greater recession as opposed to the GFC, pardon me, great financial crisis. We have bubbles disinflating in virtually every asset class. Back then, it was one, and that asset class was single family homes. That asset class got grossly inflated as a result simply of one thing: subprime liar loans. Anybody who wanted to buy a house could. They didn't have the capital. They didn't need to have the background credit score. They didn't need to have the income. All they needed was a warm body and a wet signature. That grossly accelerated single family home prices. But when that that turntable stopped turning, then markets declined, and they declined aggressively, and for extended period, like 2 to 4 years, depends on the market that you're in. This bubble that we're in is virtually every asset class. It's single family homes for certain. We'll talk about that in a moment, but it's also commercial real estate. It's the stock market that is currently trading at 3 standard deviations above the mean, meaning that at all-time highs or at or close to all-time highs and at great risk. But we don't seem to be paying attention to that, which is an entirely different story and conversation. Um, Today, we know for sure that all property types are getting hammered and values are falling faster than I have seen in my short 30-year career. It's extraordinary. We've got a variety of headwinds that are imminent, and these are only the obvious ones, but it's the credit crunch. Regional banks, which is a primary source of debt for commercial real estate, have dramatically pulled back, and we'll talk about that more also later. The yield curve has inverted, meaning that the short-term maturities yield higher returns than the longer-term maturities. And when that happens, it has 100% of the time forecasted a recession. And that recession, based upon historics, is likely to happen. Well, if it's not already happening now, it's likely to happen in the next 2 to 4 months. And there's a whole story, and that's a conversation that's not for today, but yield curve inversion forecasts crisis. And the yield curve is as inverted today as it was back in 1929 prior to the Great Recession or Depression. We're dealing with nasty inflation, largely brought on by really bad Federal Reserve policy. More on that later. We have challenged consumers. I read today that credit card default rates are accelerating faster than they have, inclusive over the last 20 years, inclusive of the Great Financial Recession and the regional bank crisis. We saw 3 of the largest regional banks fail in the last 6 months. And that, my friends, is more likely than not the tip of the iceberg. And probably one of the most egregious things that's occurring today in terms of commercial real estate in particular, but it also translates to the equity markets because corporate debt has gone through the roof, is interest rates. Interest rates are rising faster than they have in more than 40 years. And the problem also is that they're rising from extraordinarily low rates. Fed funds rate was at 25 basis points a year and a half ago, and now it is at 5.25, 5.5. Brutal. So my question to you is, all these things add up to extreme challenges. Is it a greater recession or is it a greater opportunity? I think the latter. No doubt there's going to be challenges. No doubt there's going to be a lot of pain. And I don't wish that on anybody. But the question is, what do you do with that? Do you take advantage of it? Do you pivot? How do you prepare? Do you pivot and you prosper? My 3 Ps. Or do you expect to do the same thing that you've been doing for the last 10 years and survive? And I think the answer has got to be part A. You prepare, you pivot, and you prosper. This is one of the scariest charts I've seen in my history. And it's longer than I would like to think. My undergraduate and graduate work was in economics and statistics, mostly because at the time, UC Irvine, my alma mater, didn't offer a business school, which was great because I think fundamentally everything comes down to supply and demand. And this chart talks about demand. This chart talks about supply. But let me be specific. This is a chart of M1. M1 is the primary money supply in circulation here in the United States. It's the money that's in your pocket, your bank account, your checking account. It's in your safe at home. It's in your safe deposit box. It's money that's liquid and readily available. You can access it virtually anytime. Go back here to what is likely to be the late 60s, early 70s. You see us all the way through 2008, 2009. 2009, you see a slow and gradual increase in money supply. And that's because there was household formation, there was business formation. We needed more money in circulation because there was more demand. In 2009, with Ben Bernanke at the helm of the Federal Reserve, he started printing money at a pace that we had never seen in history. They called him Helicopter Ben Bernanke because he literally was throwing money out the helicopter doors just to inspire and create an economic boost and to really stimulate our economy, if you will. And frankly, it worked. We didn't, although it was incredibly painful for many, many people, we didn't suffer the extent that we otherwise would have had he not taken aggressive action. Well, that's not the scary part, guys. What's scary is what happened right here in April 2020 when we were in the midst, or I should say the front end of the COVID pandemic, when all businesses were shut down. So effectively, we're at the worst pandemic in 100 years, and our economy was shuttered. Um, Federal Reserve, in their extraordinary wisdom, to put it very, very kindly, dumped $17 trillion into our economy, made everybody rich almost overnight through PPP and stimulus checks. We increased M1, the money in circulation, by 500%. As you can see, that's never been done in the history of the United States. Why they were so dramatic and so aggressive, I think only history will tell. But the fact of the matter is they were. And this is the primary cause of the inflation of virtually every bubble that you're aware of out there, whether it's single family homes, which have grown 40%, the stock market, which has grown 40% from pre-COVID highs, Bitcoin, used automobiles, you name it. Almost every asset class has grown and grown dramatically in terms of value. And that's because we created demand. That demand was created through making everybody rich. If you look at household wealth, we hit a point in 2021 that household wealth was so far above where it's ever been in history, it's almost ludicrous. But that explains this, right? When you put all that money in the consumer's hands, and the consumers, by the way, do drive our economy. They represent 70% of our GDP. When you put that much money in the consumer's hands, it's inevitable that bubbles are created. In this case, bubbles were created in every asset class. And those bubbles are disinflating today. Some slower than others. The stock market inconceivably is at or close to all-time highs, trading at multiples that are at or close to all-time highs, when we know there is great risk in the environment, very, very strong concern around the credit quality in the S&P or NASDAQ. So I apologize, by the way, if you've seen me make this presentation before. I'm a huge believer that the Federal Reserve has put us in the situation we're in today. Creation of bubbles, which drives inflation, no doubt about it. And then using this stick here, which is interest rates, to try and club us over the head, try and destroy effectively, almost overnight, our economy. This is a 30-year fixed rate interest rate for single family homes. Note that it's been declining since roughly 1982, during Paul Volcker, who was the then Fed chair's reign. It's been declining pretty significantly, very significantly, actually, over a very long period of time. And there's a lot of reasons for that. We as lenders, we as investors are far better able to create risk-adjusted returns by diversifying that risk. But what he did, what the current Fed chair, Jay Powell, who, by the way, it would be lovely if he submits his resignation here soon, because the same guy who got us into this trouble is not the guy that's going to get us out of it. What they did is aside from injecting all that liquidity, they lowered interest rates through quantitative easing to the lowest rates we've ever seen in this country, in the country's history. And they left him there for a very, very extended period of time. Again, they were concerned. Look, they were concerned that the economy was effectively shut down and we would end up in what could have been far worse than a depression, but it was a massive overreaction. And I know that in hindsight, everything's 2020, but it's still mind-boggling. So the big problem that we're challenged with today in commercial real estate is not that rates were so low, although that certainly is contributory. It's that they accelerated so quickly. So the Fed funds rate was as low as 25 basis points. And over a 16-month period, Don't quote me on that. They went from 25 basis points to 525 basis points. That is huge in terms of when your low point, when your starting point is so low, 500 basis points is dramatic, right? And it's almost inconceivable. And the effect of that is showing up today in the economy. So look, who am I? What am I talking about? And how do I know what I'm preaching to? I'm the CEO and Chief Restructure Officer at Performance Advisory Group, and we do three things, all which intersect at the corner of distressed and distressed real estate. We create, first and foremost, we create solutions for clients dealing with loan defaults and imminent defaults. Borrowers who own commercial real estate, small and large, who are facing a default and the potential loss of their real estate, which in many cases is their largest asset, and could lead to, in many cases, like 1031 buyers and DST investors, huge consequences, more than just losing that asset, but having to write a big check to Uncle Sam. We create alternatives to foreclosure, and that's what we do. We do it very well. I've been doing it for more than 30 years, starting as a bank guy and a special servicing guy, and then as a consultant, and also as a manager of a very large, several multi-billion-dollar platforms. I know this, and it's weird. I geek out on it. I love the chess game that is associated with managing through a default and creating strategic solutions that are win-win, meaning the bank wins and the borrower wins. We deliver these solutions through such means as loan modifications, discounted payoff, loan guarantee resolutions. The list goes on and on. But because it's such a creative industry, believe it or not, there's as much of an art as there is to a science in this space. The second thing we do is we teach industry professionals strategies in terms of how to pivot. Actually, let me start with prepare, pivot, and prosper in this environment, which is essentially what the series is all about. Speaking engagements is one way in which we do this. I speak with some of the larger brokerage houses here in the US and larger investment platforms, and I teach them the rules of the game because, guys, the paradigm has dramatically shifted over the last 6 and 12 months. It's very, very different. And we'll talk about that more here in the future. What I want to share with you is this. I'm not pessimistic at all, but I'm realistic. I see this coming. It's happened time after time in our history. And those that prepare and learn the games of the rule of the new game and step into the paradigm will absolutely crush it. It's not, for many, it's not just surviving, it's thriving. And that's part of the message I have for you today. You can't keep doing the same thing over and over again that you've been doing for the last 10 years. That will not work. You will not succeed, guaranteed. But if you embrace the new paradigm, embrace the new rules of the game, you could absolutely crush it. And that's always that way. There will always be superstars in a down market. In fact, more millionaires and billionaires are created in a down market than in an up market because they're buying when nobody else wants to buy. They're transacting when no one else wants to transact. So be that girl, be that guy, be that player. And we'd love to show you how to make that happen. Yeah. And the last thing we do is we invest in distressed commercial real estate. Everybody invests, right, at deeply discounted prices, but those prices continue to fall. It's catching a falling knife. For the most part, our pencils are down. We're aligning, and we have actually aligned ourselves with multiple capital resources, capital partners that are ready, depending on the deal, to jump in with us and make a deal happen, whether it's rescue capital, buying the asset out entirely, buying out the entire equity position, or supporting them through a mezzanine solution or preferred equity solution. We've got it. That's what we do. And without sounding terribly arrogant, we're very good at it. I'm not very good at a lot of things, but this is something I embrace, I geek out on, and I enjoy. I find it fascinating that we're still really, I mean, arguably we're not in a recession, right? That the numbers don't support the fact that our economy is contracting. But the reality is it feels like a recession, particularly if you're in commercial real estate. And so I mentioned Starwood right here. Starwood again, Barry, CEO, founder, chairman, made his billions by buying distressed commercial real estate and distressed notes, non-performing notes. So give me a moment, please. One of the largest commercial real estate owners in the country, deep into most asset types, commercial real estate property types, has recently defaulted on more than one mortgage on multi-million dollar, like $100 million, $210 million properties. And it could be argued that we're only in inning 2. And that's just Starwood. Starwood defaulting on large commercial real estate loans, essentially saying, going to give you back the keys, which, by the way, is a total misnomer. Lender never owned the real estate, so you're not giving back the keys to anybody. They're all debt. They're never equity. But it's not just Starwood. It's PIMCO. It's Brookfield. It's Columbia Trust. It's some of the best and the brightest in this industry are throwing up their hands and saying, don't think I can make this work. Can't raise the equity. Don't want to raise the equity. Think there's way more downside, and I'm not willing to protect my position because it's a negative equity situation. We talk about that a lot on this channel and on this platform. And we're going to see that perspective accelerate a lot over the next few years, which is, gosh, I owe far more than the real estate is worth. Why am I going to throw additional money at the real estate? Well, periodically we can find you a solution for that. We can do a discounted payoff. We can buy the note. We can find creative solutions that will allow you to avoid foreclosure and reprice your basis in the real estate. But when these guys, the best and the brightest, are saying, nope, take back the keys today, it's a little scary. Again, we're probably in inning 2. I mean, no one really knows the story behind that. Nobody knew what the Federal Reserve was going to do back in 2020. We don't know what the future looks like, but we can reasonably guess because history, although it doesn't repeat, it rhymes. And history gives us some really, really clear indicators as to what's going on. Some of them I shared with you earlier: yield curve inversion, broke consumer, that sort of thing. So pencils are down for us, guys, because we think there's a lot of downside to experience. But that downside could be extraordinary upside for those who take the opportunity to educate themselves, develop the right relationships, and be in a position to transact. And when I say to be in a position to transact, although I know that transactions in the commercial real estate world are off 80% over the course of the last 6 to 12 months, that's going to change. And it's going to change dramatically in the next 6 months at the outside. Why? There's a tsunami of maturing and defaulting loans coming our way. And I think we're literally just at the leading edge of that. It hasn't fully hit us yet, but it will. And every one of those transactions, every one of those loan defaults will be a transaction, will be a foreclosure, will be a receivership sale, will be a transfer. It will be a deed in lieu. It will be a note sale. It will be, you name it. Every one of those loans that are defaulting tied to real estate will represent a transaction, and distressed real estate transactions will be the very bulk of future activity in our space. So again, that's the space you need to step into. It's $2 trillion. That's $2 trillion That's 10% of total real estate valuations on an annual basis. More if you look at only from a debt perspective, but the answer is it's going to happen, guys. And those that are prepared will be the superstars, whether you're an investor or a service professional, broker, mortgage broker, asset manager. Learn your skills. Now's the time to do it. Super important to share with you. And I say, here's the thing right here, guys. Lenders and servicers now control the transactions because they're in a loss position, meaning that if the property sells based on today's valuation, the lender or the servicer, meaning the CMBS bondholders, are going to take a loss, which puts them in a control position. 80% of the trades are likely to include a loss to the lender or bondholder, which means they control the players, process, and outcome. So learn this game. You learn this game, you will control your future. If you don't learn the game, you're going to be a pawn that gets bashed aside periodically. Again, pivot and prosper, or attempt to do the same thing again and again, expect a different result. That's not going to be the case. This is always the way it works when there's a significant economic downturn, particularly as it relates to commercial real estate. One of the most important things I'm going to share with you today is simply this, that they all have, when I say they, I mean lenders and servicers, whether it's a national bank, a regional bank, a special servicer, a balance sheet lender, a credit co, whatever, it doesn't really matter. They all have one objective when it relates to a loan that's defaulted or will likely default. They want to minimize losses, maximize recoveries on a net present value basis, which means not only they want to get the most back possible, but they want to do it as quickly as possible. So the time value of money is really, really important. If you walk away from this pop-up webinar, which is one thing, this is what I would like you to recall. They all have a singular goal. Some embrace that goal more than others. National banks, regional banks, certainly more than CMBS special servicers. But that's changed, which is the good news. So how do loan defaults get resolved? There's really just two ways. Either the loan stays on the lender's books or it gets paid off in some form or fashion. Resolution is the general terminology that those in special assets use. Did you resolve the loan? Yes, I resolved the loan. Which means that it's either gone or it's back to some level of performing. Resolutions that remove the loan from the bank's books, bank, special servicer, credit company, balance sheet lender, doesn't really matter. It's all the same. They can either sell the note to a third party in bulk or one-off, and it always happens at a discount. The sale of a note, which, by the way, there's more than $60 billion worth of notes being offered in the marketplace today, or at least will be in the near term. With the collapse of Silicon Valley and Signature Bank, the FDIC took a portfolio of mortgage loans and is now offering them in the marketplace. And those notes are going to be sold at a discount. That discount's fairly easy to understand. Most people who buy a note are looking to, at least at some point, either create great yield or own the real estate. If you want to own the real estate, you basically look at the underlying value of the property and discount that by 10 or 20% for sales and disposition and the risk associated with an extended foreclosure period or bankruptcy. So you discount it, and you discount it dramatically. So note sales, not a super effective way to go about resolving loans, but certainly happening today in a manner that I have not seen ever in my career. I have led very large note sale programs, but nothing even close to approaching $60 billion. And again, I want to reinforce with you guys, we're at inning two, at least in my opinion. Take that for what it's worth too, by the way, because I could be wrong. All too often I am wrong. Generally not about this stuff, but man, yeah. So discounted payoff. Note sales, certainly one great way for lender or servicer, regional bank, national bank, to get a loan off the books, sell the note. And when the market's declining rapidly, in other words, valuations are declining rapidly like they are today, an easy way to minimize that risk is to sell the note. Discounted payoff is actually a better solution for most lenders and servicers because the discount between the real estate value and the price that they're going to get paid off is minimized. Um, when a property is sold and it's distressed, right? If the loan is non-performing, it's in default, the property is in distress by definition. But when that is sold, it's being sold more likely than not at market value. And a lender will test that, by the way, when they're looking at accepting a payoff far below their par value or the balance of the loan on their books and your books. They're gonna determine, okay, is this reasonable valuation? They'll back that up with an appraisal. So discounted payoffs, because you don't have a huge discount for time value of money, nor do you have a discount for the risk associated with foreclosure and ultimate sale of the real estate, which includes bankruptcy, is a far better solution for most lenders and servicers. And then last, of course, how to pay the loan off or how to get the loan off the bank's books is to pay it off at par, which is happening less and less frequently today. There are a lot of options when the loan stays on the books, and I've only mentioned a few here, but certainly because we know there's a wave of maturities coming in our direction, the simplest way to manage that is to kick the can down the road and do a simple loan extension. My strong suggestion, and by the way, this is what we do for a living, a 1-year extension, which requires significant pay down or deposits, not a good solution because things are only going to be worse 12 months from now. But loan extensions, clearly an easy way for them to put it back on the performing status, kick the can down the road. Basic modification of terms, which could be a whole host of things, reducing the interest rates, changing the amortization, maybe changing the collateral. There's a variety of ways to change the basic terms of a loan and return it to performing status. And then there's a full-blown restructure, which is everything I just essentially mentioned. It's potentially gaining additional collateral, improving the recourse or expanding the recourse element of the loan, changing the underlying terms. It's everything. And let me give you a great example though of how we do what we do. A friend of mine owns a multifamily property back east. She said, hey, called me out of the blue and said, in 3 days, my property is going to be foreclosed upon. And I'm like, okay, one, why did you wait till now to call me? And two, tell me the story. Well, we understood the story and there was a ton of equity in the real estate. And I said, let's get on the phone with the servicer. We did. And we said, look, there's a ton of equity and there's a ton of positive cash flow in the real estate. Yes, she's delinquent, but we can cure that with a simple loan modification. If we don't get that modification done, which by the way, she had applied for ineffectively, and we'll talk about that more later, then we're literally are going to be forced to file bankruptcy. Now, this is one of those situations where there weren't what's called bad boy carve-outs, where if you file bankruptcy, it creates a recourse element. That wasn't that situation. So just the mere threat, guys, of bankruptcy in that situation allowed us to postpone the foreclosure from Friday, August 18th through the middle of October, giving us time to negotiate a more comprehensive loan modification. Anyways, this 10 things is something I did a couple of years ago, believing a couple of years ago that commercial real estate would be far more distressed than it was or would be for literally 2 years. And that goes back to the chart I showed you. When you have that much money in the economy and you create that much wealth essentially overnight, it sort of brushes over a lot of the underlying challenges. This will be the basis of our conversation going forward. If you'd like a copy of this document, email me. Happy to send it to you. You need to know who your lender is. If you don't know your counterparty, then you are deeply handicapping yourself. Every lender has a different set of objectives and governance. High level, yes. Overarching theme is minimize losses, maximize recoveries, net present value. But that doesn't mean that's always adhered to, nor does it talk to the governance associated. So national banks, regional banks, they are overseen by regulatory agencies like the OCC, FDIC, and Federal Reserve. They have strict guidelines in terms of how they need to manage their book of business. Very, very straightforward, very simple. By the way, pro hint, banks always have two separate books for accounting for their loans. One is the borrower balance and the other is the bank's balance. So the bank will in some cases write down the bank balance based upon the value of the real estate. They will take all of the income, all the interest that you're paying, and apply it to the principal balance to reduce that loss exposure. Bottom line is this: banks don't like non-performing or underperforming loans because it hurts their balance sheet and it hurts their income statement. So know your lender. If you don't understand your lender, who they are, what they do, what their set of governance is, and what their primary drivers in terms of objectives is, you're literally handicapping yourself. If you'd like more insight on that, reach out to me. Like I said, I geek out on this stuff, and I'm available to you to support you in whatever you need. I say the reality in most cases, the end result of working together with your lender or servicer rather than at odds will almost always lead to a better outcome. A great example is when you engage your attorney to negotiate a workout on your behalf, they're engaging their attorney. So it's attorney to attorney. It's expensive, it's time consuming. And although I have great respect for the law profession, reality is they don't understand the business well, some of them don't understand the business like those of us that have spent 30 plus years in it. Lawyers are fantastic in terms of mitigating risk and quantifying your exposure, but they're not good, not always good. Apologize for you attorneys out there. They're not always good at determining your potential strategies. That's where an expert and a strategist comes into play, which is what we do, and we do it pretty damn well. Contact early and be prepared. Look, personal contact and negotiations is absolutely critical. Developing a relationship is important. If you know your loan's going to mature in 6 months and you've done your best to refinance it, but you've had zero luck and you don't expect that luck to improve, reach out to them. Tell them, look, I know I've got this maturing loan. I'd like to talk to you about loan extension opportunities and possibilities. But know this: the special assets officers, the guys that are your counterparty, whether it's with a special servicer or with a bank or a balance sheet lender, credit corp, doesn't really matter. More often than not, the people on the front lines with these lending institutions and servicers are the best and the brightest. And the reason for that is simple. Losses can greatly overcome any income corporation can bring in. In other words, a single loss can wipe out all income, net income for a year. And so putting the best and brightest on the front line helps to minimize those losses. Getting back to the overarching theme, minimize losses, maximize gains, net present value. Minimizing those losses is going to be a primary objective over the course of the next 2 to 4 years. Yeah. These guys are good. Respect them and show respect. Investigate and build your knowledge. What I mean is, once you know who your counterparty is, try and find out as best you can what they've been doing. Are they doing loan extensions, loan modifications? Would they prefer to have a discounted payoff? Would they prefer to sell the note, which is the case in many, many situations? Ask your network of friends what this bank or this servicer has been doing. And if you're a real estate investor, manager, borrower, developer, you probably have a solid network of associates. Ask around, find out what this entity, this enterprise has been doing. That knowledge will serve you well. I assure you of that. If you're a CMBS borrower, God bless you. But there's a lot of information available because the CMBS bonds are publicly traded and there's reports associated with that. So if you can find the vintage and number of your pool, you can find out delinquency ratios, what's on the watch list, including your property potentially, what the special servicer says about your property, and what they've done historically in terms of loan workouts and modification. Critical guys, know your freaking loan documents. If you don't know the contract between yourself and your lender, then you're putting yourself at a massive disadvantage. Great example is bad boy carve outs. Almost all commercial real estate loans have this concept called a bad boy carve out, wherein if you do especially egregious acts like file bankruptcy or divert funds or are wasteful as it relates to the real estate, it will trigger liability to you or the borrower or the guarantor directly. And so understanding those actions and not taking them is going to be critical for you. But it's the contract you have between yourself and the lender. You need to understand it because I guarantee you this, your counterparty knows the contract. They know the ins and outs of it. Know it. Yeah, it's likely if you're already in default, by the way, that your counterparty knows and has an idea what the value is. They know what the tenancy is. If you're keeping up with your monthly reporting, they have a pretty good idea what's going on with the real estate. So don't try and hide anything from them. You're not going to be able to pull the wool over their eyes. It's not possible. Well, maybe it's possible, but it's not probable, at least. Yeah, know your documents, my friends. Know your tenancy. Your tenancy is your primary driver of revenue. If a lender comes to you in the heat of negotiations and said, you've got this tenant, they're 25% of the occupancy, they're expiring, the loan is or their lease is expiring in 2 months, what's going to happen? And you like, well, I actually haven't had a chance to talk to that tenant. They're going to lose deep faith in you. You need to know your tenancy. You need to have built a deep relationship with them, because without your tenants, you are screwed. They're the drivers of your revenue. Your revenue drives value. Your revenue drives cash flow. Your revenue drives your ability to repay that debt. And that's what lenders care about, servicers too. The deeper your knowledge of the revenue stream and your expenses, by the way, the more faith your lender is going to have in your ability to manage the property and execute favorably a loan workout. Beware the downside. A lack of knowledge is troubling. It's deeply troubling for a lender and servicer. One of the things they can do really simply, and I'm seeing this happen far more this downturn than in 08 and 2000, is they're appointing receivers. And the court appointed receiver can step in, take the accounts, take the capital accounts, take the books, take the real estate, and manage it themselves. You're out of the equation. And by the way, once you're out, you're done for the most part. There's exceptions to that rule, but once a receiver is appointed, the lender has basically determined their path of action, which is start the foreclosure process and then get the receiver more likely than not to sell the real estate. You need to understand that's a possibility. You could lose control. You could lose possession. And ultimately, if that comes about, you will lose your asset. Know your property. And of course, this is obvious, but know your strengths, know your weaknesses, know where you need to spend capital, know where, again, we'll talk about tenancy, know where your tenants are at, where they're likely to be. So the better your knowledge of the property, the more likely your lender is going to have faith that you are the right person, rather than, as an example, a receiver, to step in and manage it. Perceived lack of faith by your lender or lack of knowledge is going to be troublesome at a minimum. So my book, if you haven't downloaded and read my book, it's just a guidebook, but it's packed full of knowledge that I've accrued over a very long career. And basically it gives you the keys to the kingdom when it comes to a loan workout or restructure. And there's 3 P's, and it's not prepare and pivot and plan. It is plan, pro forma, and proposal. That's just coincidental that they're all 3 P's. They're all P's. Actually, let me start here with prepare a business plan. You need to be able to figure out, just for your own good and for the sake of your lender, how you're going to take your real estate from where it's at to today to point where you've maximized value, which means you've maximized cash flow, which means you've maximized the lender's ability to maximize recovery and minimize losses. So your business plan could be really simple. If it's a single tenant liquor store on the corner, it could be, we're going to repair the parking lot, paint the exterior of the building, clean out the interior, and we're going to lease with national brokers that have a solid relationship with AMPM or Circle K or whatever, if the real estate's conducive for that, right? So this could be really simple, or on the other hand, it could be more comprehensive. It could be, well, we own multifamily. The units are underperforming. Rents are way below market. We know we need to spend additional capital. We'll raise that additional capital. We'll improve the rents. We'll improve the units. We'll lift rents, clean up the common areas, and move it from a class C to a class B, or a class B to a class B plus. So your business plan can be really comprehensive or really simple. In all cases, you need a plan, and it shouldn't be, I'm going to lease the real estate. Lender will look at that and say, that's just bullshit. Let's go back here, start with the pro forma. Once you define your business plan, you need to build a pro forma, and the pro forma will talk about all your revenues and all your expenses. So you've got your income, you've got your expenses, you've got your capital contributions, CapEx. It's all going to be defined in a single document. It's not nearly as complex as I am making it. On the other hand, if you're very sophisticated, it's probably much more complex. But basically, it talks about future cash flows, both in and out. Future cash flows are the primary means by which a lender recovers their loan, whether it's through amortization or added value and then the ultimate sale of the real estate. Bit complicated, but your pro forma is all about numbers, and that's the language your lender or servicer speaks. They speak in accounting. So you need to speak in accounting too, and you need to be really well defined about how you prepare your pro forma. We do this all day. You need some assistance. We have got off-the-shelf pro formas for virtually every asset class. If you like our assistance, we are more than happy to help you. And then I jumped over know your competition. This is obvious, right? But if you don't know your competitive set, you're not being realistic in terms of the marketplace. If you don't know what they're doing, how they're performing, what rents they're charging, what their expenses are, what their tenancy is up to, then you're in trouble, right? You need to know your market, and you need to know it intimately. Your lender will test you on this, by the way. And then you prepare a lender proposal between your business plan and then, more importantly, your proposal or your pro forma. You're going to project future cash flows, and those future cash flows will literally define the type of resolutions that are available to you, whether it's a discounted payoff, a loan modification, loan extension, full-blown restructure, whatever. Your pro forma will dictate the outcome. And by the way, it doesn't mean there's a single outcome, because that would be simply too easy. It means that there's going to be a variety of outcomes, but you've narrowed it down. And so your pro forma, critical piece, drives the proposal. The proposal could be anywhere from a simple loan extension, which might mean that you need to bring more equity to the table or not. The equity or the loan extension could include an interest rate reduction, which allows you to keep current on your debt given your cash flow constraints. And maybe there's an A-B loan structure wherein you have a primary loan where your existing loan's carved into two pieces, your A loan, which you know you can service, given your debt service and your available cash flow, and then a B loan, which is more of a hope note, just an option. But look, your proposal drives your pro forma drives your outcome. And certainly this is something we can help you with. We do it every day. And that's part of the chess game, by the way. It's one of the things that makes this really, really interesting. A pie in the sky plan proposal, pro forma, will put your request at the bottom of the stack and likely lead you to foreclosure. You need to be comprehensive in the way that you interact with your lender servicer. So the more comprehensive the package you deliver, the better chance you're going to have to succeed. You want to do their job for them to the extent that you possibly can. A really poorly performed and prepared plan, proposal, and pro forma will end up at the bottom of the stack. It's inevitable. Been in that space. I run multiple divisions and special servicing operations. I know how this works. The path of least resistance is always taken. The path of least resistance is accepting or modifying a proposal that is backed up with substance. Hope that makes sense. Moving on, guys. Know your options and build a team. As I told you earlier, understand your lender, understand the options and what the lender's been doing historically, but also understand what happens if you're not successful. What are the consequences of a foreclosure? If you're a 1031 exchange buyer or a DST, a TIC or a DST, consequences of foreclosure could be huge, which might mean that you put more equity into a deal where there is better chance of not recovering that equity, at least in the near term. But understand your tax consequences, in which case you might need to certainly bring a tax advisor, CPA, or other consultant on board. We don't do that. We know that space. We know that business really well, but we don't do that. Your CPA probably can, or your current financial advisor can at least guide you in the right direction. Yeah. So let me give you some examples of things that we have done recently. This is one of my favorite deals, which is probably why it's on the top of the list. Assisted living in California, Southern California. Property was purchased through a syndication in 2019 with the idea of convert it into a higher level of care for the residents. About in the end of 2019, early 2020, COVID came along and crushed operations. Nobody wanted to leave their mom and dad or put their mom and dad in a place where COVID could very well be rampant. The loan defaults. Property was acquired at $27 million. Underlying value of the real estate and operations declined to $12 million in less than 2 years. The loan was $18 million with a $9 million recourse component. 50% of the loan was recourse. So if you defaulted, the lender took a loss. They're coming after you individually. And by the way, this borrower had more than sufficient capacity to cover that $9 million. We arranged a discounted payoff and a sale of the real estate to an affiliate. And so we sold, with the lender's consent, the property for $12 million, a fraction of its previous value. The lender took a $6 million loss, and we settled recourse, the loan guarantee, for $250,000. How did we do that? That makes no sense. The answer is we controlled the real estate. And we said, look, we're not going to pay the loan off your books until we can also settle the recourse component. It was the end of a quarter. We know they wanted the loan off their books because it was impairing their income. So we said, we'll do this deal, sell it for $12 million, which, by the way, was the value of the real estate. But at the same time, we'll settle the guarantee. And instead of what you wanted, which was $2 million, $3 million, we'll write you a check for $250,000 and then we'll be done. It's over. They accepted it. That deal happened in certainly less than 30 days, and I think closer to 3 weeks. It was a great deal. My client said they hadn't slept that well in 2 years since they went into default on the loan. And by the way, the acquiring entity freaking crushed it. They dumped $1.5 million into operations, and operations is what assisted living is all about, not necessarily the real estate. Brought the value back in less than 6 months to somewhere close to $22 to $24 million, depending on how you value that stuff. So the buyer made an absolute killing. The lender got the loan paid off, put some additional cash in their books. And the owner and guarantor walked away really happy. That's a really good example of the way I think all deals should happen. It should be a win-win-win situation. Challenging, but with the right authority, with the right knowledge base, and the right participants, it can happen. Church in Texas, we did the loan, which was a bond structure, matured. Property was in foreclosure, and if you know Texas, foreclosure can happen as quickly as less than 30 days. There were about the ownership was about to lose the church to foreclosure, and they called us and said, "Look, what can you do?" The loan was, again, bonds structured with an A portion and a B portion. We paid off the A piece at or close to par, and we paid 10% off par for the B piece. We refinanced the property at a rate far lower. In other words, we paid off the bonds with refinance proceeds from a new lender at a rate that was far lower than what they were currently paying. Saved the church, helped them out in terms of their interest expense on an annual basis. And now the church is frankly thriving. Self-storage in New York, $18 million, it was a $30 million asset when it was first acquired. Natural catastrophe came along, causing low occupancy, driving negative cash flow, negative leverage at 150% loan to value at the time, simply because of the devastation. Now they had insurance proceeds to re-improve the property, but they would have to work themselves out of a deep hole in terms of occupancy. Loan was in default, and the borrower was incredibly frustrated. They're like, it's a national bank that they were dealing with. And they're like, I can't seem to talk their language. I can't make any progress. When I say, what can I do? They say, pay the loan off. We stepped in, and in less than 30 days, we didn't have it fully resolved, but we put the property under contract to a third-party buyer. In that contract was an earn-out provision that allowed our seller, my client, to participate in the upside because they were selling it at such deeply depressed prices. Once the occupancy grew, and we knew it would grow, the seller, my client, would recover some of that additional value. Paid off the lender at 80. I don't think it was quite as high as 80% of par, but it was close. And as a result of that earn-out provision, our borrower recovered almost all of their initial equity. Good solution, win, win, win. Buyer wins, seller wins, and lender wins. Matured office loan in Southern California, very recent deal, loans in default. And office, Southern California. I won't tell you the location because we signed NDAs with every one of our clients, but it was in deep trouble. And it wasn't 92% loan to value. It was probably closer to 140% loan to value, but appraisers and appraised values today are still way up here. They haven't seen the reality of that compression of buy sell spread. If we went to sell the property, it would have sold for a fraction of its loan amount. Didn't want to do that. Lender didn't want to do that. We saw upside. Our borrower had a significant lease in their back pocket, which would dramatically improve cash flow and to some degree value. Borrower, all they had to do is repack reserves, and we were going to repack the reserves anyway so we can execute the new lease and pay for tenant improvements and leasing commissions. It was a great deal. What we offer our clients, full service workout solutions. We will work with you directly in preparing your business plan, your pro forma, and your proposal. That's what we do. That's a huge portion of our business. Whether you're in a default or likely to be in a default. And by the way, multifamily people, I know and I feel your pain. Office people and mall people, I know and feel your pain. Reach out to us. We're here for you. Schedule a call. It's free. We'll spend 30 minutes talking about your situation and how we might be able to assist. We'll talk about your probable options, what that lender has done historically, and we'll give you some strength and support. That's what we do. We also do teaching and speaking engagements. I love getting up there and sharing my knowledge with real estate professionals, whether it's a broker, mortgage broker, owner investor asset manager. This is what we do when working with some of the larger investment houses and some of the larger brokerages. And that's a business that, like I said, I mean, I've been in this business far too long. I should be retired at this point, but I enjoy the process of teaching and sharing what I know. And the more knowledge that we share today, the less likely we're going to end up in a massive catastrophe, which is frankly the direction we're going. And then again, we strategically invest in deeply discounted commercial real estate. Our pencils are largely down, but we're looking. We underwrite deals fairly frequently. We talk to our potential capital partners almost every day. At some point, we certainly might be looking for investors to co-invest with us on future deals. We're looking for high yield deals, deals that we pay far, far below replacement value, deals that we have a huge competitive advantage. And that competitive advantage is simply that we're buying at a basis far below all of our competitive set. When everybody else in our environment owns their property at $500 a square foot and we're in at $100 a square foot, well, that changes the game. And that gives us a huge opportunity to crush it. And that's what we want. That's what we shoot for. So there's my contact information, guys. Reach out to me anytime, phone, email, book a time to chat with me. Some of the questions that have popped up are, what do we expect interest rates to do over the course of the next 12 months? Unfortunately, we've had to repack our treasury account, our general account. As you know, probably we ran out of money or got damn near close to running out of money, but we increased the debt ceiling. So we had to fund more than $1.5 trillion over a very short period of time in new securities, treasury bills, and bonds. And that has pushed up yields, and that has cost borrowers significantly, whether it's corporate borrowers or commercial real estate borrowers. I don't expect that to reverse. Generally speaking, in a stressful and risk-on environment, risk-on meaning there's risk there, yields tend to increase to compensate for the risk associated with that. Now, look, the U.S. was just downgraded from AAA to AA+. Ludicrous, in my opinion. But that also has an upward pressure on interest rates. And so that this interest rate environment is not going to reverse itself anytime in the near term, even if the Federal Reserve decides in their infinite foolish wisdom. Did I mention that we should ask for Jerome Powell's resignation and all of the FOMC? I didn't. There it is. Even if they choose to reduce interest rates anytime in the near term, which is not very likely at all because they're pursuing a 2% inflation rate, rates are not likely to come down because spreads have widened. There's more risk in this environment than we've seen in a very, very long time. 14 years. 12, 14 years. And that just means that people want to get compensated for that risk, and that therefore yields will stay high. What do I expect to be the most distressed asset class? Well, we know today it's regional malls and offices. And frankly, I think that's a huge, huge investment opportunity, just not today. At some point in the near future with the right capital structure, for certain, but just not today. If time proves itself consistent, and like I said, history doesn't repeat, but it rhymes, we've got somewhere between 3 and 5 years before we see the bottom of prices, whether it's the equities market. By the way, equity markets are ludicrous. But 2 to 5 years or 3 to 5 years between now, or the top, I should say the top, which was somewhere back in 2022, and the bottom. So that gives us time, and it gives you time to prepare and strategize, and be very choosy and picky about where you invest. Multifamily is one of my favorite asset classes, and I've invested hundreds of millions of dollars in that space. But at today's prices, No way. No way. Cap rates are still lower than the cost of capital. In other words, cap rates are still, on average, in the US, around 5%, 5.25%. Your borrowing rate is somewhere closer to anywhere from 6% to as much as 8.5%. That's inverted. Just like the yield curve is inverted, so is the spread between cap rates and your interest rates. And until that solves itself, and by the way, it's not likely to solve itself in a manner that improves values. It's more likely to solve itself in a manner that depresses values. We're not investors unless it's a one-off deal. I mean, look, there are some deals being sold at foreclosure auction at really fantastic prices. Not always, but they're there. There's some notes that are being sold at prices that are very, very appealing, whether you want to enjoy the yield as a lender or own the real estate as an owner and an investor. Some really compelling opportunities there. But cap rates are going up, guys. Historically speaking, there's been a positive spread of anywhere between 100 and 200 basis points between cost of the capital and the cap rate. And that allows for positive yield. When you have the cap rate inverted with the cost of capital, you have what's known as negative leverage, and that's not sustainable. The last time we saw that was back in 1979. The only reason why it exists today is because we don't have willing buyers and willing sellers. There's a giant spread between bid and ask, right? Sellers are still thinking yesterday, buyers are thinking tomorrow. So, what do I think about the conversion of office buildings into multifamily? I think it's a great idea, but it's rare that the economics actually work. It takes an older office building with a smaller floor plate, which allows more light in, and residential units need light for the conversion to happen. And you also have to buy it at a very, very, very low basis for the economics to work. And I will tell you, most people think the multifamily space is very robust today. I completely disagree. I think that all that liquidity that we put in the marketplace through the Federal Reserve made everybody rich, so they didn't mind paying an extra $100 or $200 a month. And some of them actually had multiple units. They had a place here in Southern California, and they had a place in Montana. Whether it's a rental or a owned piece of real estate, that shit's done, guys. That's gone, at least in the near term. So, yeah, another question. Okay. So the question is, what is the greatest asset class in terms of distress? Well, today, as I mentioned, it's office and regional malls, but that's changing. We've got a wall of loan maturities happening in multifamily. We also have a huge reset for those on an adjustable rate basis. So if you bought in the last 3 years and you bought using an adjustable rate mortgage, you're in trouble. Several of our clients have come to me. In fact, just today, one of my clients said, look, we hedged, but we didn't hedge well. We did a 1-year hedge on our interest rates. Cost of that hedge. So basically what it means is this: they bought the property fully leveraged, 70% loan to value at a 3%, 3.25% interest rate, but it was adjustable. Interest rates have more than doubled over the course of the last 12 months. And they're losing, instead of making $300,000 a year in net income, they're losing $184,000 after debt service. The cost to put a new hedge on, a new interest rate cap, has increased 1,000%. 1,000%. And as I mentioned just a moment ago, cap rates have gone up. So the question is, what do they do? And it's not a simple solution. There's so many variables involved in that. But I will tell you, as an asset class, multifamily is in deep trouble. And like I said, I've invested a lot of money into that space. And I love it. And everybody needs a place to stay. But rents are starting to decline, guys. Cap rates are going up. Loans are maturing. Frankly, when you look at the book of business of most regional banks, it's largely multifamily. They gorged on it, as many of you gorged on multifamily investments over the last 3 years. It looked great, right? On the other side of the equation, I would say this: to help temper that distress in that space, a lot of people placed fixed rate debt at extraordinarily low rates, at 3.25, 3.5, 4%. And for those who did that, kudos, because that will be your advantage. That will allow you to stay competitive in a world where rents are declining, occupancies are declining. That is a huge advantage when you pay your greatest expense at a fraction of what your competition is paying. You're in, you're gold. Guys, I have a lot more questions, but we're out of time. So it was a pleasure chatting with you. Interestingly enough, we just spent the last 10 minutes talking about multifamily. Next week's conversation is about the challenges and opportunity in the multifamily space, both as a borrower, investor, owner, and manager, as well as a potential investor. That opportunity is ripe and it's golden. And I'd love to share with you my thoughts. So thank you again for spending a little bit of time with me. It's been my pleasure and my honor. Have yourself a fantastic day. Cheers.